SoFi CEO Anthony Noto said, "We saw an opportunity to lower our debt. Since IPO in 2021, the stock has been dropping, but after the last earnings has gained some momentum."
I think it's important to understand why we did the convertible deals, why we did the buyback, and the benefits to shareholders that I don't think are truly understood by the market.
Well, this is your chance.
The first point is we did this deal from a position of strength. We just had a record 2023, over $2.1 billion of revenue, up over 30%, 40% growth in our members, our first quarter of GAAP profitability, over $400 million of EBITDA generation, and gave an outlook that was going to be for full year positive GAAP profitability in 2024, as well as continued strong growth in our tech platform, as well as our financial services business. And we're going to be more cautious on the personal loan business. What we saw was an opportunity from that position of strength was to lower our cost of debt. We had two pieces of debt that were quite expensive. One we did in 2019. It is a Series 1 preferred that pays 12.5% interest.
So good.
5 years after we issue it, we can buy it back in May. If we don't buy it back in May, we'll have to not just pay 12.5% interest, but it actually goes up to 15% interest for the next 5 years, and we can't buy it.
Okay, so in other words, it wasn't like you could play around. If you tried to think that maybe we'll go to 12 and we got to May, you would have, and it didn't go to 12, you could have been hurt. It was not like the risk was, hey, listen, it could go up to 20 here. It was the opposite, which is that you had to get this piece done.
Well, I would put it this way. We saw it as an opportunity to do it and have a negligible impact on our GAAP earnings per share, and also combined with the buyback, have it be accretive.
But did you think the stock was going to get crushed like this?
Let me finish. Have it be accretive to tangible book value per share by 8 to 10%.
Okay.
When you do a convertible, there is pressure on the stock from investors shorting the stock against the convertible. It's a delta hedge. That does happen. So there is typically 5 to 10% decline. But the reason why we did it is really important, because I think this is what will put some momentum back into the stock. First is we had this 12.5% debt. We also had another piece of debt that's about $500 million that we pay 7% on. So we're going to save between $40 and $60 million of interest expense a year by refinancing from 12.5% down to 1.25% where the convert is, and from 7% down to 1.25%.
Subscribe for more.